I have a small quiz. Uh, Between 2000 to 2018, in last 18 years, Infosys and Marico, two companies, profit growth has been 25% for 18 years in Infosys. 25% compounded for 18 years is like a almost impossible kind of event, but it has happened. And Marico about 18%. Now, what could be the return in both the companies, starting from 2000? So 2000 to 2018, I'm giving a primer in terms of earnings growth. What could be the return? Anybody has 30? 30 for 18 for Infosys? Marico, Bata? So see the numbers. It's 8% for Infosys and 30% for Marico. It's all game of valuation. And you know why it has happened? The P differential. In 2008, it is not 2008, I'm sorry, this is 2000. It's a mistake. It's 2000, in 2000, the P was 206. That was the peak of dot-com boom. And 16 is the P in 18 March. From 206 to correct in 18 years, it literally the overvaluation of the stocks. I mean, this actually makes you think. Because if you had a perfect foresight in 2000, that for next 18 years, Infosys is going to grow at 25%, and yet you would have not made any money. And forget about beating the market. You would have been lucky to just save yourself at a fixed income rate, if you're right for 18 years. And look at Marico, which was a kind of a good company, known company, small company. It was very respected company even then. At 10p when you bought, and the re-rating of 54p, 5x. That is the game of valuation. The guys who understood the valuation in 2000, they kind of walked out of the stock, and the guys who understood again the valuation of Marico, they bought into it. And I think we have a gentleman called Sanjay Bhattacharya. He suffered as well as benefited in both the stocks. That's why I picked up these two companies. So just to set the backdrop, in the Bible it says, I mean, this is the best quote on valuation ever heard. In the Bible it says that love covers a multitude of sins. Well, in investing field, price covers a multitude of mistakes. For human beings, there is no substitute for love. For investing, there is no substitute for paying the right price. Absolutely none. So this is Vandenberg, 95-year-old Century Investment Management in Houston, I think. He works out of Houston, very old guy, Second World War veteran. So this guy, you know, is amazing in terms of his insights about investing. But this price thing is so important. You just saw so it is very important to understand I just wanted to give the backdrop in which we have done the study, and we'll get back to this a little later. So what is the importance of understanding value? So RNA5 value price gap. See, in market, everybody knows the price all the time, but very few know, or they have the inclination to know the value, underlying value. Because price doesn't give you any edge. How do you figure out what is the value? So a lot of people have no competence to figure out value, and a lot of people, I mean, at least the people who work in this tower, they have competence to value, but do they really bother about valuing companies? Because that's the biggest crisis. The people who are competent, they also don't bother about value. They only bother about what has happened to the price. So the way serious investing works is that price is always there. Figure out the value and buy only if there is a margin of safety. There is a huge gap between price and value. So we have done, as I said, we have done of the QGLP, we have taken care of Q, we have taken care of growth, we have taken care of longevity in last 23 studies. And this is the time when we are looking at price, reasonable valuation related to quality and growth prospect with a high margin of safety. So how the evolution of valuation itself has happened? So in 30s and 40s, when the when actually the first time anybody bothered to write about, there must have been some books, but actually security analysis came in 1934. And in 1938, Bud Williams wrote the book, Theory of Investment Value. At that point of time, there was a formal, some kind of writing in much more organized fashion about the valuation in the markets. And at that point of time, incidentally, there was a recessionary time, depression time, I think probably one of the worst depression. So that time, people wanted to buy the stock. Actually, nobody wanted to buy stocks. So the people wanted to buy stocks only post 1929 boom. They wanted to buy at discount to the book value. Clearly, if the book value is 100, I don't want to bid more than, the whole market was at discount. Then in 50s, when the economy started coming, this is in America, when the economy started coming out of the recession, they started saying, okay, we believe that company is going to work, but I don't want to buy equities unless the dividend yield is higher than bond yield. Dividend yield to be higher than bond yield in US. So dividend, if the bond yield is 8%, I want dividend yield to be 9%, 10%. Then only I'll buy. That went on for another 15, 20 years. Then they realized that the companies are not distributing all the earnings which they have. So then they said, let's look at the earnings growth because they're redeploying the profits. So then there was a boom in the valuation was based on the earnings growth, irrespective of the quality, irrespective of cash flow. And then Buffett and Manjar came, they said, don't look at only profits, let's look at the quality of cash flow, quality of profit. And there the quality investing started, See's Candy, Coca-Cola, American Express, all sorts of things they started buying. And they started also writing about investing in quality companies. And that kind of era lasted, or even it is lasting now, and investing in quality companies, and thousands of books has come. And then more recently, this is a Robert Hangstrom's summary. He's saying that new emerging, what you call valuation tool is CROCI, cash return on invested capital. We have not used this particular technique right now. Our own understanding is limited, but I think as we go along, we are going to explore even this possibility. So price is what we pay, value is what we get. So we can control what price we are paying only if we understand what is the underlying value. So present value, see, I think there is no confusion that the correct value, the theoretical value or approximate intrinsic value, whatever you might say, the best definition and the only definition is present value of lifetime cash flows. The only problem in this definition is how do you figure out the lifetime cash flow. And so we have tried, everybody tries his own bit of trying to get approximately, everybody goes wrong, longer you go, more wrong you are, but I would like to be wrong on the right side. I estimate 1,000, but it turns out to be 10,000. Rather than I estimate 10,000, it turns out to be 1,000. So the whole effort is to figure out that approximate valuation of the companies. So intrinsic value for the bonds is very well defined, because here what happens is that you know the coupon rate, you know the tenure, you know the when are you going to get back the money. So when you, all the things, there is no uncertainty, you can actually define a company, a bond which is 8% yield on 1,000 rupees. If you want to have yield of 10%, the price will be 877. You just put the numbers and the number will come out. So, but then equity is not that easy. Neither you have the fixed coupon, nor you have the fixed tenure, and you don't know even at what rate you should discount. So everything is kind of uncertain when you come to equity investing. And it is your choice what assumptions you have for all the three things. So we have tried to, basically we were looking for a formula where, in fact, we wrote in studies, when we wrote about QGLP, we said we are looking at a triangle of 25% ROA, 25% growth, and 25 P. If we get these three, we knew that we are going to make 25% return without any problem, and index is going to do 15%. We'll have a nice margin of safety, about 10% outperformance. That's what the thinking. But we didn't know why we are saying 25 P. Should it be 20? Should it be 30 or 35? That now I think it will be much more clearer and we found that QG and P is the best discussed, through the discounted cash flow. So here, this is slightly busy, but earnings growth rate of 20%, ROE of 25, and these are the only two variables, because your continuing growth rate, terminal growth rate is of 8% and cost of equity of 13. This is just these two are, so if your earnings growth is 20% and ROE is 25, you see the free cash flow. Every year after year, the free cash flow is being built. Because you can make profit, but if your growth rates are significantly higher than ROE, or ROE is significantly below the cost of equity, so basically market is looking for massive source of free cash flow year after year. So here, if your ROE is 25 and earnings growth is 20%, you get nicely laid out free cash flow. Second is, if your earnings, the problem is here, the earnings growth is 30% and ROE is 14%. Then you see the negative negative flow of the cash you keep building up because your growth capex is building up at a very, very rapid pace. So what you are paying today of very high P multiple is for the free cash flow, which is probably, if at all it comes beyond 10 years of the life of the company. But people have, in the mood of optimism, people are willing to pay very high price for the free cash flow, which is likely to come way beyond after 10, 15 years. That is what exactly is happening in a lot of companies today. So basically, it is ROE, earnings growth, and cost of equity that determine the value triangle. So you have the ROE at the top, earnings growth at the one end, and the cost of equity. Once you have these three things, that's what you give the value, or you can determine value divided by price. I mean, the earnings divided by price, that gives you PE. So this is and all of them, I mean, like cost of equity, you can say is 12, 13%. 13%, incidentally, cost of equity at 13% is the rate. Actually, we have the longest index is Sensex, which technically started from 7980, but actually started trading from 1st January 1986. So the index calculation before that is not very healthy, because the index moved by 7 times between 1979 and 1986. So obviously, there is a lot of, it's not a good base. So, but from 1st January 86, if you do it till date, it is about 13.5% compounded return for last 32 years. So we are saying cost of equity is about 13%. And even if you go by the other formula, 8 plus 5, 8% risk-free and 5% equity premium, that is about 13%. But I don't have a big grip over this. It could be 11%, 12%, that is a matter of discussion. But cost of equity is very important. Earnings growth, ROE, these three things you have to figure out. And then that will give us some kind of a numerical value number. And the way it works is that how ROE and growth determines. So, so the growth capex, where exactly the free cash flow comes? Basically, earnings growth minus the growth capex gives you the free cash flow. So the growth capex, if your ROE is at 20% or 25% or 15%, and if your growth rate is 20%, then delta PAT is 20% and 20 rupees. To earn 20 rupees, at 25% you need 20 bucks. At 20 rupees, you need 100 bucks. And at 15 rupees, you need 133. So you actually have, at one level of ROE, you have free cash flow. And at other level of ROE, that is 15%, you actually need to put more money. And these two makes a massive difference in the valuation of the companies, which market at times is not able to figure out the difference between high ROE company growing at the same pace and low ROE company which is growing at 15% or so. So that 15% requires a lot of capital to be inputted. So next insight is about all growth is not good. And this is very, at least I didn't know about, I was not so clear about this. If ROE is less than cost of equity, high growth destroys value. If the company is destined to make 11, 12%, which bulk of the companies do, they will never create value. They will never create value. And 60, 70% of the market is there. Today we'll show how big a portion of the market is stuck below 13, 14 PE, ROE. So if your cost of equity is 13%, if your cost of equity is 13%, at 10%, zero growth is the best. Because at zero growth, everything is free cash flow, there's no growth capex, and hence 1 by 13 is 770 is your value. But below that, if you start growing, you start destroying wealth. At 13%, irrespective of the growth rate, if ROE is equal to cost of equity, at 40% growth, 13% ROE. There are a lot of popular company today which are standing here, 12, 13% ROE and 40, 50, 60% growth. Actually, the P multiple should be 7 or 8 or 10 at best. They are trading at 40, 50, 60 P. And that is where either the ROE goes up or the valuation collapses. So this is what exactly is the, so all the growth is not good. What growth is good? Sorry. Yeah. So growth adds value when ROE is higher than cost of equity. So if you start with the third column, which is 15%, 20%, 30%, that is higher than 13%. So every column, at every growth rate, it starts creating value. So if ROE, if growth rates, so growth adds value only if ROE is higher than cost of equity. So this is slightly, so there are three things: ROE, cost of equity, ROE, and growth. All three works in tandem. So beyond a point, increase in ROE does not add much value. It took me some time to grasp this, but if a company is at 13%, of course there is no value creation, but it goes from 13 to 26. Look at the graph. Till about 40%, there is an very rapid increase in the P. But after that, from 40, you go to 400% ROE, or even 4,000% ROE. The P increase is going to be minimal, because free cash flow reaches almost 100% of the profit. And your profit, your free cash flow can never cross 100% of the profit. So hence, your gain in the value is going to be very limited. Your gain in the value can be only as much as you add in the free cash flow. So one has, so next is, earnings growth and valuations are exponentially correlated. The moment your ROE is higher than cost of equity, you just got to push the growth. Because after that, it is simply exponential. 12% growth, 24% growth, 36% growth, everything will be proportionally higher. And there is no limit. Of course, you cannot grow at a high rate for very long time. But earnings growth has that power. And that's why markets goes crazy when for 3, 4, 5 years, the growth rates go very high. Then the markets start giving crazy valuation, which they are right if the growth had continued. But we'll talk about it a little later. So low ROE companies should focus on raising the ROE. Low ROE companies should focus on raising the ROE, and high ROE company should focus on raising the growth. So look at carefully. 1% higher ROE gives you, 1% higher ROE gives you to high ROE company 1% gain. If you push the ROE beyond 30%. When you take it from 30% ROE, company A, to 31%, it will give you gain of only 1%. But company B, whose ROE is 16%, you raise the ROE by 1%, the value created is 12%. Now the 1% growth, when the company is highly profitable, but growth is low, growth is at 10%, you grow it by 1%, it gives you 7% additional value. When the company B, where ROE is 16%, but growth is 20%. So 1% higher growth will give you only 3%. So basically the conclusion is, if the company is below cost of equity, the ROE, so basically what happens is, all the new companies in India, they push for right from day one for growth. Even we are also, victim of the same thing, where day one, people start building very rapid growth of 70, 80, 100%. And then what happens is, you have not built the, success model for making the profits. Look at Diageo, what they did. After acquiring for last 5, 6 years, all the analysts were pressing for growth. They didn't bother about the growth. They went about building the franchise. And now this quarter, they have declared 20% EBITDA margin. It may not be sustainable, but still, they are way above. They went about building it, all product rationalization, sales, marketing, branding, everything they said it right. Now they will focus more on the growth. So that is the way to go about it. And most of the successful companies, even I believe Avenue Supermarts, first 10 years, they built very few stores, they tested the model, and then when they found it to be working well, then they rolled out so many more stores. And they are going very, very methodically in terms of rolling it out. And so it is very important when you start growing and where the value, when the growth creates value. Sustaining high ROE is even bigger challenge. I used to think that high ROE companies will keep remaining high ROE forever. And there are a lot of companies. So we started from 1998, the companies which sustain ROE about 13% only, cost of equity. So in 1998, there were 136 companies. And every year, we kept on seeing the same companies at about 13%. How many companies are left? There were only 22 companies left. And this is the story you start from any year. So very few companies can sustain even 15, 17% every year, not for a very long period. And the companies which, and then hyper earnings growth is even more difficult. And this is another realization to me. I used to think the companies which are growing at 25, 30% in this growth economy will keep growing for 5, 10, 15 years. I mean, and that's what the market thinks. And that's how they build valuation of 100p, 80p, 90p, thinking that the growth will continue for a very long time. So here, look at the, in 98, in the, just look at the first half, 5-year period. The companies with PAT growth of about 25% for 5-year period. So in 98 to 2003, there were companies with 20 crores profit. There were about 188 companies. Out of that, 28 companies had a more than 25% growth, average growth for 5 years. In the next bucket, between 2003 to 2008, it became 8. And in third bucket, from 8 to 13, it became 1. So where is the growth? I mean, high growth, it just doesn't sustain. And you do it on any period, 99, 2000, 2001, everywhere, by the third bucket, no company survives. And that one company is nothing but HDFC Bank. That was the only company which survived for 15 years of more than 25% growth. So it just, even if you do 3-year bucket, you see what happens. I mean, first bucket, second bucket, by the time it is third bucket, very little, and by the time it is fourth bucket, nobody survives. So basically, high growth phenomenon can last, even in this high growth country, for not more than 5, 6 years. That is the highest. Now, when do you buy these companies? Do you buy when the growth starts? Before that, of course, you are the best guy, you will be featured in the fastest growing companies, and you will win big time. But if you buy after growth has started and 4 years elapsed, when the market is all there, P is very high, and you buy G plus 4, you know what is going to happen. You are buying right at the cliff. It will collapse. Literally, you can say that the company which is growing at 30, 40% for 3, 4, 5 years, its days are counted, forget about the years. You know, just few quarters it is going to collapse. And then the market will realize and collapse the entire thing. So high ROE, high growth. You know, I mean, intermix of both is very, very rare. So we have seen this. You see this slide is very simple. This particular strategy works without any folly. I mean, QGLP is a thought process around this line. High ROE, high growth, bought at reasonable price. So that trouble is still there. We'll talk about it. But high ROE, high growth has always worked. It is summarized here. So high ROE, high growth has given consistently between 98 to 2018, every single periods of 5 years, it has given 27% return. The second is most surprising, but globally also this is a result. High growth, low ROE, reasonably low ROE, like more like 14, 15% ROE, has given 21% return. And third lowest is the 14%, which is high ROE, low growth. They give just about the market return, because if you see average Sensex return this period is about 14%. So the only two outperforming segment is high growth, high ROE, high growth, low ROE. So that's the only way to make money. So growth is very important component of outperforming in the marketplace. So that was about valuation. Let's look at the pricing. You know, I mean, many times we are not able to figure out what is the valuation of a stock because we don't have clue about the what will happen, how much it will grow. But let's look at just the valuation, pricing, what works, what doesn't. So we have looked at price to earnings, price to sales, price to book, price to relative market, PEG, payback ratio, all the possible, whatever I have seen in my learning that we have done. And here we've seen, if you happen to buy, this is a 3-year alpha from 98 to 2015. So this is a 17-year, all the periods of 3 years we have taken, and all the instances are there. 4,000 instances are there. So whenever you bought below 10p, there is a good alpha of about 5%. But beyond that, it's all about market performance, or actually at various levels, you see the level of underperformance. So if you buy above 50, 60p, you are literally not supposed to make money. Literally, I'm talking about if you buy all the companies, there could be one exception here and there, but if you buy above 50, 60, 70p, I don't think over a period of time it is going to make money. Look at the price to earning relative to the market. If market is 21p today, and if you buy below that, then if you buy less than 1 time of the market, even that leaves a little bit of the alpha at about 4%, and there are 2,000 observations, 50% of wealth has been created during this period, but this is kind of a significant, I would say. So most of the time we don't know what is the P of the market. Right now P of the market is 21, so if you can buy decent company below 20p or 18p, I think you have a good chance of having some small alpha. The PEG, I'll just explain, this is the PEG. Now, those are the ratios which we're kind of looking at today or past. But this is the ratio which is looking into the future, where your earnings forecast is coming into play. TTMP divided by future earnings CAGR. Today, it is such an unfortunate time. Most of people don't know what is the last 12 months TTMP. People, all the analysts, they talk about, now I think we talk about 20p. We don't even talk about 19p. So, in fact, I have seen even my own analysts, they don't know what is the TTMP. And they know when they're sitting before me, first thing they should talk about is TTMP. So they have to do extra work to figure out what is the TTMP. Gautam, you have to be really observant about the TTMP. So TTMP divided by expected 3 years PAT CAGR. And so the real problem is the TTMP. Right now TTMP is running at 50, 60, 70. So to make it look a little more attractive, they look at 20p, 21p, whatever. So, so this is how you calculate your 3-year PEG. So if you do a PEG of 1, it works very well. It works just brilliant. So at less than 1 PEG, the average 3-year alpha, not the return, average 3-year alpha is 19%. And 33% of all the observation, 1,300 observation out of 4,000 is below 1 PEG. So whenever you find below 1 PEG, pile on. This is going to give you massive amount of return, but of course you need the growth inside. And even up to 1.5 PEG has worked very well. But beyond that, it's just a disaster. And PEG 1, below 1 works across the time period. So we chose 3-4 of them, 2000 to 2005, when it was kind of coming from the peak of the one of the bull runs. At that point of time, alpha for 1 year was 13%, 2 year was 38, 3 year was 27. You see what has happened. But then the discipline has to be, this is the period in which index did very badly. Still alpha was, even the PEG 1 companies were below, but the alpha was high. Between 8 to 13, that was the only year, 1 year. Between 8 and 9, 1 year, there was a negative alpha of 4%. Otherwise, you look at across the segments, the alpha is in double digit. Between 13 to 18, which is very recent, look at the alpha. If you could buy 17%, 39% 2 year, 3 years in 28, these are compounded alpha during that particular period. So this is staggering kind of result, provided we can practice it. Payback ratio is rehash of the PEG only, but it is more stringent in the sense that this is next 5 years profit. In PEG, you can have an inside of 3 years, but here you need 5-6 years of growth estimates. And here if you buy less than 1 PEG, of course you have 17% alpha. Price to book also works. If you are able to buy stocks at about 1 below book. So below book buying, this is like a Graham style. Very few worthwhile companies you'll find below book. But if you can buy below book, I think it works. Again, 5-6% alpha is there. Price to sales also works if you can buy good companies below one price to sales. So what works, what doesn't in pricing is all given here. In all the parameters, if you are able to do it one time PEG, one time payback, one time price to book, one time sales, below 10 PE, or price related to market less than one time, I think everything has alpha of different order. But the best alpha is if you have one PEG, even 1 year inside, forget about 3-5 years, that's too long. But if you are sure about next 1 year's growth, and if you can buy it, say 30% growth, you can buy at 27, 28 P, you will still have a nice alpha. So this is what we have seen. And what doesn't work is more powerful. Look at it, anything you pay 3 times, and it just doesn't work. Above 50 P has never worked. I mean, there could be one exception here or there, but what doesn't work is very clear. 3 PEG and this kind of thing. So these are the few very, right at the top is Avenue Supermart with 105 P. Last 3-4 years growth has been fantastic at about 50%. If this company can sustain, incidentally, chairman of this company sitting here, so if it can sustain for next 5 years this kind of growth, of course this price is justified. But if you look at other companies, page 85 P, this is yesterday's P. United Breweries is 82, P in hygiene. So this kind of P multiples, at least in the past, they have not made money. Now this could be a different time. And whenever we say this is a different time, you know what happens. So these companies are at crazy valuation. Are we buying at G plus 3, 4? Or we are buying G minus 1. I mean, is it the start of the growth period we are buying today? Or actually, bulk of the growth is done and we are buying at the end of it. So we have to be a little careful. Nestle is 62 P with 1% growth in last 3 years. And 3% in 5 years, 10 year is 11%. So we have to be very careful in terms of what kind of a growth are there and whether these companies will not sink. They will make a positive return, but they will be far lesser than even 13%, more like 8%, 7%, 12%. But they will not sink you because they are such fantastic companies. So in conclusion, the 2 key drivers of intrinsic value of return on equity and earnings growth. Companies create intrinsic value only when they earn ROE higher than cost of equity. Low ROE companies must focus on increasing ROE. High ROE companies should focus on increasing growth. PEG less than 1 is near infallible formula for healthy outperformance. Current market valuations demand robust earnings growth to justify current valuation, which remains elusive. Hence, expect market to remain soft. Thank you very much.